Welcome back to the investment challenge. Today's topic is the ISM manufacturing PMI, which is basically a tool we can use to determine when we should invest in the stock market. It's a tool I use for my timing, and you can use it to determine if you should invest in more cyclical stocks or more um, stocks like companies that produce more things like toilet paper because even when the economy goes down, you will still need toilet paper. So like here in 2008, when the economy was crashing, there are certain things that are still important. As I said, toilet paper or food is still important, but buying the new, I don't know, iPhone, iPad, is not so important. So we use this tool, as I said, for market timing. And it's very easy because you have this line at the 50 mark, and reading below 50 indicates a slowdown of the economy, and a reading above this line indicates growth. And the higher this reading is, the more growth is expected. And this line gets, let's say, calculated by a questionnaire or a survey that is sent out to, I think, 500 or 800 companies in the US. And the business owners have to fill it out, and they can answer questions like how is your inventory, how many new orders do you have, and the results can you see here. And yes, you can see now this line indicates slowing US GDP, which basically means we should be careful when investing in more cyclical stocks. But we are also at a historical low point. It's very low. Last time it was this low was in the Corona crisis, and at the financial crash in 2008. So this is maybe a good opportunity as soon as this shifts, as soon as it indicates growth again, to invest in the stock market. So this is definitely an indicator I'm looking at every month, because this gets released one times a month. I hope my English is not so bad. I hope you still can understand what I'm meaning here. But yeah, it's quite interesting because we are so low now, and as soon as it shifts, I'm looking to buy cyclical stocks, because they should outperform let's say, the toilet paper stocks. And to back up what I just explained, we can look at the US GDP. We just turn it on here, and let's slide this back a bit. And now you can see it's closely correlated to US GDP. As you can see here, it drops, and then the next US GDP reading is very low. So yeah, and you can use it to predict the stock market as well. Let's look at the Spider ETF here, which is the ETF for the S&P 500. And as you can see here, when we look at the past decades, let's just use this example, like the crash in 2008, you could see since 2004 this survey was already indicating a slowing economy. Stock market was still rising. It was still above the 50 line here, but it showed, okay, economy is cooling down. And yes, after the crash, you could use this survey to invest again. You see here, it starts growing, it starts going up, and you could nearly hit the button right there to invest in the stock market. And same in the corona pandemic. It was already slowing down here. Stock market had some troubles to making new highs, and then of course the pandemic hit, and this was enough to drive the S&P 500 down to its former lows. And now the same thing. This thing, the survey, the ISM PMI was sharply rising as the stock market, and now it was cooling down for a few months. And as I said, now I will look at this indicator, and when this starts to shift, I'm looking to get my portfolio fully invested. And as I said, I will focus on mainly cyclical stocks. And that should be enough for now. I hope you understand what I was saying. If not, please just write a comment below. I will happily answer your questions. And see you soon.